We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us today. We talk retirement. It's in the name, Decker Retirement Planning. If you have questions, you can always call the team. It's 833-707-3030. We'll give you that number throughout the program. But really, the opportunity is there. If you have questions, concerns, boy, I wonder if we can retire. Do we have enough? Will our money last? That's a great opportunity to talk with Brian, Arrin, the team at Decker Retirement. There's no cost to do so. 833-707-3030. You can always go to the website as well to learn more. Where the offices are, DeckerRetirementPlanning.com, DeckerRetirementPlanning.com. And of course, every time we start this show, and I might do it a couple times during the program, but you do have the ability to go to that website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. There are 12 different things you can download, including Brian's book on retirement, The Decker Approach. There's a 3 Principles of Retirement book on there. There's Checklist Challenge. I think there's 35 or so things. If you can check them all, you're probably good to go. And there's also a sample income plan. That's just 4 of the 12 things you can download. No cost to you. It's just there for your information. DeckerRetirementPlanning.com under the heading of Safer Retirement Education. All right, Brian, welcome to the show. You and Arrin will be talking a little bit about risk management for retirement. Is that right?
That's right. So, Mark, we want to start off with how many people that come to our offices to talk about retirement planning think that they've got this handled, and mistakenly, Arrin, think that because they've handled their 401k for 35 or 40 years in retirement, that they've got this when it comes to distribution planning. So, Arrin, I'll tee it up for you. In accumulation planning, people are at work, their income comes from their work. Markets drop 30 or 40 or 50%, no big deal, because you're putting new money into the markets every 2 weeks. You have the time, the 3 to 5 years for the markets to recover, and your income is coming from work. So no big deal. And when the markets do recover in the 3 to 5 years, because you've added money into it and you had the time and your income's coming from work, that accumulation strategy works beautifully, and you're actually better off for it as the markets continue to move on. And people mistakenly think that accumulation strategies will help them in retirement. And in fact, the fact is that accumulation strategies will hurt them. So, Arrin, do the contrast. What actually happens when you're retired, 65 plus, markets go down 40 or 50%? What happens?
Yeah, so this is a great point, Brian. It is a lot of times shocking for people to realize the impact to them in their retirement phase from those scenarios that weren't as big of a deal in the early years of that accumulation investing. So let's just take kind of a recent example where we had the 2008 loss of the 35-40% there. So when you have that kind of a drawdown and you're in retirement, what happens is really 2 things. The first is, in addition to the losses that you have in your portfolio from just the market drop, the 35 to 40%, you are also pulling money out of those accounts to spend as income, which means you've just further exacerbated that problem, right? It's not like you were able to just let that whole thing sit and recover. You had to pull money out of an already declining account balance, which caused a lot of future pain. Now, that typically happens multiple times throughout retirement, right? That drop is not 1 in 100. That drop typically happens every 7 to 10 years or so. And so it's very likely that in retirement, you're going to have a few stock market drops like that, especially where we've had pretty good returns in the market the last few years. Not to say that there's going to be one next year, but at some point in time in the next few years, we'll have another drawdown likely. And again, to Brian's point, if you have that kind of a drop in your portfolio and you are taking money out to spend as income, that is not a good combination for having that money last as long as you need it to. So for those of you that have that pie chart portfolio, the 70/30, 60/40 portfolio, something tailored specifically to your risk tolerance, that is not the type of strategy that you need in retirement. And that will hurt you when those market corrections do happen again.
Okay, that's right. And so, Aaron, the contrast is one, the accumulation years, you're adding money to a down market, and the second, you're pulling money from a down market. So, we're a math based firm at Decker Retirement. When you draw income from fluctuating accounts, you compromise gains when markets go up, when you pull money from them, and you accentuate the losses when markets go down. So if you're doing that, if you're not drawing income from laddered principal guarantees account, which is rule number one in distribution-based income, like you outlined, Aaron, that's very, very important. Let's keep going down the list. Aaron, what's another rule that we don't do that's an accumulation strategy? For example, let's talk about interest rate risk. That's something that, again, you can buy and hold and ladder your pie chart portfolio in a 401k and use bond funds. But what in fact is different about interest rate risk in the interest rate cycle that we're in now?
Yeah, I think there's a couple good points to bring up here. The first is that from like a general financial planning or a general financial industry standpoint, most people view the bond fund or the actual bonds in their portfolio as their like safe or conservative asset classes. Now, there are time periods where that does work, where those actually do provide that protection that you're looking for. And there's other time periods where that's not the case. A good example of this is in 2022. The stock market, the S&P 500, was down about 20% that year. NASDAQ was a little bit worse. And bond funds were about that same amount down. They had in between 20, 25, 30% losses. And again, if you had 30, 40, 50% of your portfolio in those bond funds expecting that that was going to protect you from the market losses, provide some volatility or some downside mitigation, that obviously did not do its job in that circumstance. And if you look at the charts for most of those major bond funds, they really haven't recovered since then. So while the stock market, the indices have done very, very well the last couple of years, bond funds have either been flat or negative during that same time period. So again, where typically those are put into place for protection and providing you income, you probably actually want to be able to rely on them to fulfill those roles, where especially recently that hasn't been the case. Now, from an interest rate risk standpoint, you're running into a couple different things here. So what we're talking about specifically when referring to interest rate risk is the inverse relationship that bond fund performance and interest rates, like what the Federal Reserve does, do to each other, where as interest rates rise, that's generally a bad thing for bond funds, causes them to lose money. So that's what happened in 2022, right? We were at an all-time low from a Fed interest rate standpoint. They spiked interest rates up. Stock market took a nosedive. That dramatically impacted the bond funds. They took a double-digit hit as well. And again, a lot of those really haven't recovered since then. So where we are in somewhat of an uncertain interest rate environment, that is a potential risk, right? So the Fed has been for a while, and everybody around them has been talking about interest rates starting to come down. And yes, there have been a couple quarter point rate drops, but as we've seen the last couple of weeks, that isn't guaranteed moving forward. Jerome Powell and some of the other Fed governors have talked about, hey, maybe we need to hold off. Maybe we need to delay this, that they're worried about inflation. They're worried about some of these other economic data points. And the initial trajectory of having rates dramatically drop over the next year or two is not set in stone. So if heaven forbid inflation starts to take off, or if we have some other underperforming metrics from an economic standpoint, it is not out of the question that we remain at an elevated interest rate standpoint, or they actually start to increase them again. So for our clients here at Decker Retirement Planning, we want to make sure that we are not putting you in a position where interest rate risk is going to work against you. We do not use bond funds like the 70-30, 60-40 allocation here because of that inherent risk where if interest rates rise again, or if we get into kind of a murky interest rate environment, that could very well destroy or derail that protection mechanism and the income producing mechanism that you're hoping to achieve by using those specific asset classes. So, Brian, anything else you'd add to that?
I'm just going to sum up what you said. 1940 to 1980, 40 years of higher interest rates. 10-year Treasury went from 2% to 15%. 1980 to 2020, specifically October of 2020, the 10-year Treasury went from 15% to 0.47. Whoever kept recommending bond funds when interest rates are almost at zero, they're not acting as fiduciary or they're not very smart, because interest rate risk was absolutely huge. And the 10-year Treasury bond, well, actually, the average bond fund is down 35% in the last 5 years since that point. So when people have that kind of risk, and now we're in a higher interest rate cycle, we highly recommend against use of bond funds because of interest rate risk. So now, Arrin, let's talk about why the number one fear of people 65 and older is running out of money before you die. It's something about the 4% rule and totally guessing about distributions. Arrin, talk to us a little bit about that.
Yeah, it's one of the things that we warn people about right up front in our financial planning process here. So when you go online and you look for how to handle your retirement income, there's going to be a number of different common strategies that pop up. One of the most popular is what's known as the 4% rule. So context here, people say, okay, over the long run, stocks average 9 to 10%, bonds are going to average 5 to 6%. So if I'm being conservative and I only pull 4% of my portfolio out per year to spend as income, because that 4% rate is below the average growth rate of the stock and bond portions, I'm going to be okay. I'm not going to run out of money. Now, that can work when we're in a extended bull market, right? When you're looking at the early 80s to the year 2000, had a phenomenal stock market, you can pull your 4% out, portfolio grows faster than that, you'll be all right. But when we get to what's called a flat market cycle, which the most recent one was the year 2000 to about 2013, this is the point in time when the equity or the stock-based portion of your portfolio goes a 10 or 15 or 18-year period without having any positive growth. So you can imagine that if you're pulling 4% of your portfolio out per year to spend as income, and you go a 10 or a 15-year period without making any positive growth on that portfolio, that's not a great combination for having that money last as long as you need it to. So the glaring issue with the 4% rule is that it doesn't take into consideration the volatility that the market is going to go through, right? You're not guaranteed a 10% rate of return every year in stocks. You're not guaranteed a specific rate of return on your bond funds. There is going to be volatility, variability, and those ups and downs can very much work against you when it goes through one of those flat market cycles. So here at Decker Retirement Planning, we do not use a 4% withdrawal approach. We don't use just a set percentage withdrawal because there are so many other aspects of a complete financial plan that it does not account for. All that does is say, hey, you've got $1 million or $2 million or $5 million sitting in your portfolio. Take this set percentage every year. You're going to be okay. It's overly simplistic. It doesn't account for your other income streams. It doesn't account for tax planning or the volatility in the market. There's just a lot of things that doesn't account for that are going to put you in harm's way at some point in time in the future. So anything else you'd like to add to the 4% rule, Brian?
We'll cover that on the other side of this next segment.
Okay.
So I will tell you one thing that will be guaranteed by Brian and Arrin of Decker Retirement Planning. Of course, the guarantee is that you will get clarity. If you have questions, you have concerns on where you are on that road to retirement, just give them a call. There's no cost. There's no obligation. There's no pressure. It's 833-707-3030, 833-707-3030. 3030. It might be one of the more important phone calls you make. Certainly today, 833-707-3030. Brian J. Decker and Arrin Wray back with more of Safer Retirement Radio with the team from Decker Retirement Planning right after this.
Just as the seasons come and go, so too do the markets ebb and flow. If market volatility is making you nervous, give Brian a call and make sure you're not taking on more risk than you're comfortable with. 833-707-3030. That's 833-707-3030.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
Tax laws change, but smart planning stands the test of time. Don't leave money on the table. Let Brian Decker and the team at Decker Retirement Planning help you maximize your tax strategy. Call 833-707-3030 today.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott. Again, the website, deckerretirementplanning.com. Questions, 833-707-3030. Talking about risk reduction strategies. And I know you've got more before we really delve into some of the weeds, right, Brian?
Right. Another issue, Aaron, that we have is buy and hold, a passive investment strategy that gives you plenty of time during your accumulation strategies. But there are times when a passive buy and hold investment strategy will hurt you in retirement. For example, look at the current market valuations that we have right now today. In 2025, we're looking at market valuations that have only been this high a few other times ever. In fact, anytime that the S&P is over 30 times trailing earnings, it's a mark. First time that happened, 1929, and markets were flat for 17 years. It took 17 years to get your money back. Second time was 1964, 18 years before you got your money back. Third time, November of 1999, 14 years before you got your money back. The fourth time we hit 30 times trailing earnings was November of 2021. So with 100 years of history and with 100% historical accuracy, we're hoping for the best. We're hoping that markets go up for the next 10 years. But I bet you my house that won't happen. I think that the chances of that happening are tiny small. Historically, when market valuations get this high, we at Decker Retirement warn people against passive investment strategies that in the last 100 years have never worked, not one time. So we warn people about buying and holding stocks, mutual funds, indexes, and ETFs. There's only two ways to make money in a flat market cycle. One is dividend strategies, where the dividends come in no matter what. And the second is momentum. Momentum is when you got algorithms that allocate money to whatever is going higher. For example, in 2000, 01, and 02, the S&P was down 50%, the NASDAQ was down 70%. But if you use momentum, you were allocated to what was going higher, and that was real estate through the REITs, gold, silver, energy, pharmaceuticals, biotech, healthcare. All those sectors went up and made money each year for 3 years. And then when the markets bottomed in March of 2003, for the next 4.5 years, it was all technology, semiconductors, small caps, and emerging markets. And then the markets rolled hard into 2008. everything. It was waterfall decline. So the nice thing about momentum algorithms is that everything is going down. You have stop losses. There was one exception. Treasury bonds were up over 20% that year. So you would have had exposure, some of your exposure to portfolio with treasury bonds. Now, recently in 2022, when Russia invaded Ukraine, S&P was down 19, NAS down 33, bonds down 20, commodities were down. Momentum took you into the energy sector. The frackers, the drillers, the natural gas, the crude oil companies, the platforms, all of those made 15 to 20 when the markets, most people lost 30% that year. In retirement, you can't afford to go 10 to 15 years of flat market portfolio, have you make nothing when you're in retirement, when you're drawing from that portfolio with the expectation that markets will take you higher and help you finance your golden years of retirement. So at Decker Retirement, this is a key, very important point in distribution planning is the knowledge to use risk strategies that can and are designed to make money in up or down markets. In fact, we even go further. When the market's trading above its 200-day moving average and the markets are said to be in an uptrend, these are hand-picked strategies that are very good at capturing upside in the markets. When the markets cross the 200-day moving average and we are in a defined downtrend, we put the defensive team on the field, a fully different strategy where we put defensive strategies in place. These are still momentum strategies, but defensive strategies that are focused on and have historically done very well in down markets. So at Decker, I think it's going to be very hard to find another retirement planning, money management company that goes to those lengths. But Arrin, there's one other factor that really separates us when we're talking about risk from accumulation and distribution. In your 20s, 30s, 40s, and 50s, Arrin, we see clients that have their money, 100% allocated towards stocks. And then they retire and they go to their banker and broker that tell them to have a 60-40 or 70-30 portfolio. 60 or 70% of the money, all that they've earned in their adult lives in the stock market. If they do that, we think that that's insane because distribution strategy has quite a different mix. Arrin, talk about the mix that we have at Decker using distribution strategies.
Mm-hmm. Yep. Yeah, this is one of my favorite things. And it does take a little bit of getting used to because, to your point, Brian, people have built those great habits over the last 30 or 40 years, right? You get into this mode, into this habit of saving, investing, putting it into whatever's going to give you the highest growth, typically means a little bit higher risk, higher volatility associated with that. And then you switch into your retirement years, right? And it's not like you just have this switch in your brain. You can just flip and say, okay, I'm retired. Everything changes now. And so one of the main things that we do here is to both coach you through the math, the financial aspect of it, and the mental aspect of it, right? Kind of getting into the mode of retirement and understanding the different seasons of life that you're in now and the way that your money needs to be adjusted to fit that specific season, fit the use case that you've assigned to that money now. So with the plans that we build, the income distribution plans, there's typically going to be three main categories of money. Category one is going to be your emergency cash. We want to make sure that you have a small cash account set aside for unexpected expenses. Second is going to be the safe or conservative portion of the portfolio. We call these principal guaranteed accounts because the principal that you invest cannot have a loss or a negative return. So this insulates you against those market drops, those flat market cycles. Third category is going to be the risk bucket. This is where market exposure and volatility is still appropriate. Now, every plan is going to be a little different based off client needs and timing and some other things, but from a general sense, most people that we work with are going to have in between 25 and 35% of their total assets in that risk bucket allocation. Now, this is very different from what a lot of advisors, especially accumulation advisors, are doing, right? When you're talking about a 70-30 portfolio, 70%'s in the market and 30% is either conservative or in those bond funds. Here at Decker Retirement Planning, we essentially flip that on its head, where we have the majority in those principal protected accounts and the minority, that 25 to 35%, held in that risk exposure account, the risk bucket there. Now, this is really important for the distribution phase of your financial life because it helps to provide that consistent income that you're looking for your portfolio to give you, right? Well, what we are trying to prevent by doing that is, hey, market had a great year. You can probably spend a little bit more on income, or dang, market's down 30% this year. You better cut back for a couple of years to recover, kind of build back that asset base. We do not want your monthly income bouncing all over the place, depending upon whether the market had a good or a poor year. So by putting the majority of your assets in those principal guaranteed accounts, it means that when those market corrections happen, whether it's a 1-year thing or a multi-year thing, you are also not losing money on those protected accounts, which in turn means that you get to keep that consistent income flowing. You don't have to take a dramatic cut to what you're spending every month based off the fact that the market took a turn for the worse. So this is one of the most important things that we do for our clients, is to make sure that they have the right protection vehicles in place, the right percentage or dollar amount based off of their portfolio in those protected vehicles to give you that income, give you that peace of mind, and help you use that money successfully for all of those use cases in retirement, right? Not only taking care of the base level expenses, but gifting to kids and grandkids, charitable giving, making sure that you can go do your trips, your hobbies, all those discretionary things. We want to make sure that we can do everything that you need us to do with that money. So it's really important for us to make sure that we have the appropriate risk exposure, appropriate principal guaranteed allocation. But again, we want to make sure that we overweight that to help you with all of those specific things.
So when you think about it, when you retire, let's say you retire in 2025, you're retired until 2050 or even 2055. Not unusual to be retired 20, 30 years in today's world. Things will cost more. Inflation is a factor. You have to have money in the market because you have to have growth, but you also need the protected side. And that's what Brian and Arrin are talking about today. If you'd like to learn more about your portfolio, how is it set up for maybe a market downturn? Do you have other monies that are available to you if the market goes down so you can let that maybe cook a little bit and maybe restore itself? 833-707-3030 is the number to talk with the team at Decker Retirement Planning. 833-707-3030. There is no cost to ask the questions, the concerns you have of Brian, Arrin, and the team at Decker Retirement. 833-707-3030. Brian and Arrin back with more of Safer Retirement Radio right after this.
Your story is unique, and so is the legacy you leave behind. Connect with Brian Decker at 833-707-3030 to start writing the chapters of your legacy and ensure it reflects your values and dreams.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott. Again, on the website, deckerretirementplanning.com, under the heading of Safer Retirement Education, there are 12 different things you can download, including Brian's book, the Decker Approach Book, but there's also the Checklist Challenge is a part of that. You can download any or all of that. Just go to deckerretirementplanning.com under the heading of Safer Retirement Education. All that is there for your information. And then you have questions, you can always call 833-707-3030 to talk with the team at Decker Retirement Planning. And, you think about that Checklist Challenge, Brian, there's a checklist that we all kind of need to go through, I suppose, before jumping into retirement.
That's right, Mark. So it'd be good for people to actually jot a note, if they can. The 6 key points to a final retirement plan, in our opinion, are, let's handle these one at a time, Arrin. One is to have a plan. Here's another big difference between accumulation planning and distribution planning. In accumulation planning, you've got a pie chart. That is not a retirement plan. Arrin, go through in detail for the radio listeners what a good retirement plan should look like.
Yeah, I typically hammer this pretty hard because people are so used to seeing the pie chart, right? You log into your 401k account, your IRA account. It's what you're used to. It's what you're familiar with. But really all that pie chart does is it just tells you what it is you're invested in, right? Do I have stocks or bonds or mutual funds or ETFs or money market or whatever the specific asset class is? That's all it really does for you. It leaves so much to be desired when you're looking at what actually constitutes a complete or a successful retirement plan. So, although investment allocation is an important piece of a successful retirement plan, it's also not the only piece. You need to make sure that you have the income planning taken care of, the tax planning, the risk mitigation, the estate planning. All of those things are going to be integral in that complete retirement plan. And again, that pie chart doesn't tell you how to handle any of those things, right? When you look at the pie chart, you can't see, hey, how much income should I pull out of this? How do I do IRA to Roth conversions or any other tax-based strategies out of this? How do I gift this to my kids or pass it to the next generation when I pass away? It doesn't answer any of those questions. It just shows you maybe a little bit about your risk tolerance and what specific asset classes you're invested in. So again, to just drive home Brian's point, if you have an advisor that is telling you that your pie chart is your retirement plan, you need to find a new advisor. Again, that's leaving so many things on the table, just leaving you open for those pitfalls when you don't take into consideration all of those other aspects that are going to make up a complete financial plan. So we want to make sure to put a proper distribution plan, a proper financial plan into place for you that does account for all of those things that become paramount in that retirement season of life.
Okay, so that is number one, is to have a plan. Number two is tax minimization strategies. And I don't know, let's talk about 3 or 4 of them really quickly. And there's over 100 that we have access to, but let's just talk about 3 or 4 of these really quick, Arrin.
Yeah. So the one that's going to be most effective for the majority of people is IRA to Roth conversions. So when you are younger, kind of working, saving up that money, the common tax advice that we see put out is defer, 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 right? The longer you can kick the tax can down the road, the better. But that means that eventually that has to be taken care of, right? That there's a point in time in the future where those taxes do have to be paid, whether that's going to be from you and your spouse or whether that's going to be from your kids. Taxes are a sure thing. So we want to make sure to hit that head on and proactively do what's going to be best for you from a tax planning standpoint. So IRA to Roth conversions are a very effective way to be able to do that. And again, everybody's circumstance is going to be a little bit different. But with the current very low federal marginal tax brackets that we have, and the high likelihood that tax rates are going to go up in the future, it will very likely be better for you to lock in your current tax rate today, use that as a form of insurance against future tax rate increases. Again, making sure that you get as much value out of those assets, pay the taxes when it's going to be the lowest on that IRA or those pre-tax dollars there. Anything you'd add to that, Brian?
Yeah, we have a grid there, Arrin, where we have a 60-year-old that lived to age 90 that didn't do IRA to Roth conversions, and $1 million IRA growing at 6% a year. The net of tax conversion was a measly $1.2 million when you take away the taxes that he paid during his life and the taxes where the family paid. When you net all those out, it's a measly 1.2. When you do IRA to Roth conversions, the same 60-year-old that did those and died at 90, that person didn't pay any required minimum distributions because the IRA had been converted to Roth. And so all of that growth is tax-free. Distributions are tax-free. And so it came out to be 4.1 million. Huge difference in taxes paid and in assets transferred. So I just wanted to add the icing on the cake there. But what about if we have a client with huge capital gains, Arrin?
Yeah. So when you're looking at outstanding capital gains, there's 2 situations that are pretty common. The first is highly appreciated real estate. Maybe you got some rental properties, you bought them for $100,000 and they're worth $1 million a piece now, or highly appreciated stock. Maybe you got lucky, you bought Google or Amazon in 2004 and you've held it ever since, and you'd really like to sell either those stock shares or the real estate. But if you were to do so, you're going to be looking at a pretty large capital gain because you've had, so much growth on those assets. So there's a couple different ways to be able to help either mitigate or eliminate that highly appreciated or the capital gains on the highly appreciated asset. So One of them is a way to be able to set up a specialized account and move that asset, the real estate, the stock shares, into the name of that account. And when you sell it within this structure, it eliminates 100% of those capital gains. You then get to set an income stream up that comes back to you for the remainder of yours and your spouse's life. It's typically a set percentage of the total. Pretty common is about 5% per year that you can withdraw back to you. Now, after you've enjoyed that income stream for yours and your spouse's lifetime, the end of your life there, the rest of the assets in that account do go to a charity that you've assigned that balance to be transferred to. So this is a phenomenal way to eliminate capital gains, take an income stream back to you, and be able to benefit a charity that's close to your heart with the remainder of those assets after you've utilized that income stream. There's another one that is for people that want to do a little bit more immediate charitable donations. So sometimes you want to be able to take a portion of those funds and use them right away, but you're wanting to push your income down into some of those lower tax brackets, whether it's a lower long-term capital gains bracket or a lower income tax bracket. And so there's an additional charitable account that you have the ability to set up, front load donations into this, and it gives you an itemized deduction in the year you make that donation. So let's say you, I don't know, $75,000, you donate it to this account, you get an itemized deduction for 75 grand that year that you can use to write off against your income. And that does help push you into those lower federal marginal tax brackets. Also get a lower tax rate on some of those long-term capital gains if you're up into that 20% bracket versus the 15% there. So a couple good strategies for capital gains.
And plus, when you make that contribution to avoid capital gains on that in that strategy, you get a massive upfront charitable deduction that many times we'll use to just move a huge amount of IRA money to Roth. Okay, what if we got last thing on, and we'll move on after the strategies here for taxes. But here's another one that's very popular. What if we have a bunch of clients with a bunch of rental real estate?
Yep. So with this, you're probably going to be familiar with the concept of depreciation, your ability to write off a portion of that property value against the income that you receive there. So by default, most people take those depreciation benefits over the course of 27 and a half for residential or 39 years for a commercial property, and they just kind of take them in equivalent increments. But that's not the only option that you have on how to take those depreciation benefits. You actually have the ability to accelerate typically about 25 to 30% of that total and use those depreciation benefits within the first 1 to 5 years of owning the property. So this is something where you pay a third-party company to come in, do a custom study where they break out all of the pieces into what are called their useful lives. So you're going to walk on the carpet, you're going to use the appliances, but things like the roofing or the windows are going to have a longer lifespan than some of those other pieces or materials. So again, this typically allows you to be able to write off about 25 to 30% of that total purchase price of the property within the first 1 to 5 years of owning that building.
Okay, so that's number one, Arrin, is to have a plan, which you just outlined beautifully and defined as a distribution plan. Second is tax minimization strategies. We have access to over 100 of those that we can help minimize client taxes. And you gave a couple examples about how to minimize or eliminate capital gains tax, how to produce tax-free rental real estate income streams, and how to make a huge difference in using Roth conversions correctly. The third thing in a properly drafted retirement plan is risk reduction. And there's 3 parts to this. Number one is quantitatively going from 60 or 70% of your money in the stock market down to where we recommend you have risk, which is 25 or 30%. Second is eliminating interest rate risk. We don't use bond funds. Arrin talked about that in detail. The third is strategically lowering your risk by using momentum strategies and dividend sleeves so that we can make money. And these strategies are designed to make money in up or down markets.
So again, if you'd like to talk with the team at Decker Retirement Planning, 833-707-3030. And as Brian and Arrin have talked about, it starts with a plan. You need income, investment strategies, tax-efficient strategies, healthcare, long-term care, legacy planning. Social Security, Medicare decisions are all part of having the plan and walking through the process with Brian and Arrin and the team at Decker Retirement. Again, that number is 833-707-3030, 833-707-3030. Back to wrap it up right after this on Safer Retirement Radio.
The holidays often remind us how expensive life can be. If you're feeling a bit more financially squeezed this season and worry about how you'll fare in retirement, give Brian a call at 833-707-3030. That's 833-707-3030.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Decker Retirement. Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement. I'm Mark Elliott. Glad you're with us. Again, the website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. You can get Brian's book on retirement, the Decker Approach book. There's 12 things you could download on that. DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. Again, you can call with questions, concerns, 833-707-3030, 833-707-3030. 3030. All right, Brian, fill us in. You've covered a couple aspects. Having a plan is number one. You got to have a plan when it comes to retirement. And then about tax minimization, you still got some other keys to this retirement planning, don't you?
That was 1 and 2, right? And number 3 we just covered is risk reduction. Number 4, Arrin, is portfolio optimization. Talk about all the different buckets that we optimize.
Yeah, so this is the way that we help take all of that hard work that you've put into getting to where you are, meaning towards that retirement phase, and building upon that to carry you successfully through retirement. So, like we've mentioned a couple of times, the strategies that got you to retirement are not the same ones that you need moving forward. So the way that we transition you from those accumulation strategies to the distribution strategies are by taking that big chunk of money, the IRA accounts, 401k accounts, brokerage, whatever it is you have, and breaking that out into the various buckets that we have that each have a different responsibility. So we talked a little earlier about how we have the emergency cash accounts, principal guaranteed or the safe portion, and then those risk bucket funds. Now, the reason why we break out the funds into the principal guaranteed accounts versus the risk strategies is because they are going to be using different investment vehicles, different strategies. They've each been assigned a different job that we want them to fulfill. Now, we do not view our clients' money as one big pot where we're just trying to tailor it to some specific risk tolerance. We help you break out each of those buckets of money to make sure that we have the right dollar value there and that we're using the best vehicle or strategy based off the purpose you're trying to accomplish. One of the things that I really try to have my clients focus on is you don't want the jack of all trades approach, right? You don't want to just do something average or do something okay with your whole portfolio. You need to break it up so that you have the best fit, the best vehicle for what you're trying to accomplish with that money. So where we have the different buckets on our plan, typically there's going to be 5 different buckets for that safe portion for those principal guaranteed accounts. And we ladder these out for various durations based off of when you're going to need the money. So you're going to need to spend some money in the first year of retirement, some 5 years later, some 10 years later. And we want to make sure that based off of when you're going to need access to those funds, we've put it in the vehicle that's going to give you both the protection, but also the highest rate of growth for that specific time period. So there's typically 5 different accounts that we will use within the principal guaranteed category. And then within our risk bucket, the goal there is to make sure that you are focused on high growth for those funds. So because you do not need to withdraw money out of the risk account, you have the ability to endure that volatility, to endure a little bit of risk, to be able to get a higher rate of return over that longer time horizon. So this is one of the main reasons we break out the risk account versus the principal guaranteed accounts, is to give you the ability to ride out some of those ups and downs that we have using those momentum models in the portfolio to make sure that you can have a higher rate of growth there for eventual use as income for those funds a little bit later on. So again, having that division, knowing exactly why each of those buckets is allocated with the dollar amount it is, when you're going to use it, how it's going to be utilized. We want to make sure that we've accounted for everything when putting into place those accounts for each of our specific clients. So anything else on that, Brian?
First of all, we use a database that lets us know what the highest earning principal guaranteed accounts are in each market. So we can look at banks and insurance companies and see what the highest earning money markets are for our liquid accounts. We have strategies that are liquid and have current yields of 6 and 7% that our clients are taking advantage of now. We've got a diversification of CDs, and we look at CDs from insurance companies that usually have better rates than bank CDs. We have variable rate investments that are using AI indexes with returns that I haven't seen this high in 40 years in the business. So I love how we're assembling a laddered principal guaranteed approach so that clients over the next 15 to 20 years can draw their income from laddered principal guaranteed accounts. That gives you tremendous peace of mind, number one. And number two, we're using compound interest to our advantage because we're drawing from the lowest earning accounts first, allowing the higher earning accounts to grow and compound. So that would be, all part of optimizing every part of your portfolio. The next, number 5, Arrin, is focusing on maximizing our net of tax monthly income for clients. So when clients come in with X amount in assets, gosh, for me, Arrin, it's like 95% of the time when we show them in that second meeting how much money that they can draw, they are happily, very happily surprised. They're surprised that it's as much as we show them because we are using distribution planning, and yet we are ultra conservative with the estimated growth rates at the top.
Yeah, it's one of the best things about the way that we do our planning is because it gives clarity. I have so many people that walk into my office that are retired and they've been spending X amount. And a lot of times what happens is that they're actually underspending relative to the amount that they could conservatively sustain because they're fearful for running out of money. They don't want to have everything gone at age 85 and have to live to 95, the next 10 years being broke. And so they're kind of minimally spending, conserving, still stuck in that frugal mindset because they don't want to put themselves at jeopardy of running out. But because we use a math-based structure here, this is not just the guess and hope for the best approach. We want to make sure that we can back up the recommendations that we have as far as both the investment allocations and the income amount that we're projecting for you. And so by having that math-based approach, putting conservative assumptions into this plan structure, it both gives you the sweet spot of making sure that you can optimally use your income, but also make sure that you're not going to be one of those people that has to go find a job at 85 because you ran out of money. So being able to have that clarity helps people understand, look, I can sustain this level of spending and still be able to make sure that I have that money for all the different purposes that I have it for. feels so good to be able to show them that, just see the light on their faces, help them understand that they can spend more while still making sure that that money is going to last as long as they need it to.
And plus, we support the plan years and years into your retirement. We don't, it's just not a one and done and good luck. Hope you figure this out. We're supporting that plan, updating it every year. I don't know firms that do that, Aaron. I don't know that other firms have a whole department of people that are updating client plans like we do. But
Yep. Yeah, because things are going to change, right? It's not like your life situation today is going to be the same indefinitely, right? You might move, one of you gets sick and passes away 20 years earlier than the other one. Your priorities for the money might shift or adjust. Income needs might go up or down. Your risk tolerance might change. Like there's so many different things between now and the point in time that you pass away that are going to adjust. And you want to make sure to have a team behind you that can walk you through those processes, make sure that you're avoiding those pitfalls while making the changes that are going to work in your favor and just supporting you throughout that important season of your life.
so if you're within 5 years of retirement, you should come in and see us to make sure that you can retire with the amounts that will allow you to pay the bills and have extra for travel and to enjoy your golden years of retirement. If you're already in retirement, you should come see us to make sure that you know that the amount that you're taking in retirement is sustainable. And most of the time, when people do that, they find out no, you can draw an extra 40 or 50, 60% more than what you're currently doing. People underdraw because they're guessing, they know they're guessing, and they're afraid of running out of money before they die. So they grossly underdraw for their retirements and sadly underutilize their golden years in retirement. One more point in the 6 key points of a final retirement plan. Number 1 is to have a plan. Number 2 is tax minimization strategies that are employed. Number 3 is risk reduction. Number 4 is portfolio optimization. 5 is the focus on maximizing your net of tax monthly income. And number 6, Aaron, are fees. Fee minimization. This is a data point that anyone can look up. The average person in the United States, 60 and older, is getting charged 1%. Aaron, how much do we charge on average?
Our average is about 0.3%. So our fee structure here at Decker Retirement Planning is a little bit different. So if you've got $1 million, you go to an advisor, they say, hey, we'll manage this for you. We're going to charge you 1% per year on that entire $1 million portfolio. Here at Decker Retirement Planning, our fee, what's called an AUM or asset under management fee, is not assessed on 100% of the portfolio. So we've talked a couple of times about the division between the emergency cash, principal guaranteed account, and the risk buckets that we put into place on our financial plans. And so our fee is assessed specifically on the risk-based portion of the money. And again, on a typical plan, that's going to be somewhere between 25 and 35% of the total. So because we don't charge on 100% of the assets that we're managing, our typical fee is somewhere around 0.3% for the clients that we work with. So summarizing here, we just want to make sure that you are absolutely knowledgeable about the season of life that you're in and how to carry yourself successfully through that. So again, there's a very big difference between that accumulation and the distribution periods of your financial life. And you need to make sure to have a distribution specialist like Decker Retirement Planning in your corner to hold your hand, help you avoid those pitfalls, make sure that you are putting all of those 6 key points of a retirement plan into place for yourself so that you don't regret where you end up 5 or 10 or 20 years down the road.
So again, you think about the number one fear amongst retirees, the fear of outliving their money. They fear that more than death itself. And if you think about it, if you sit down with the team at Decker Retirement, Aaron, Brian, and the team, and you have a plan put together, you're not going to be so fearful because you actually have some clarity into your situation. You have that opportunity every week when Brian does this show with Aaron, with Brad, with whoever he has on the show with him. But it's about you. How can they help? 833-707-3030, 833-707-3030, and take advantage of the safer retirement education part of the website, deckerretirementplanning.com. There's 12 different things you could download, but you can just start this whole thing just by getting Brian's book, the Decker Approach book, and then call him with questions. 833-707-3030. Brian and Aaron, as always, a pleasure. Enjoy the rest of the weekend. Brian, we'll do it again next week.
Thanks, Mark.
Thanks, Mark.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.